Welcome back to Simply Money. Today we're going to be looking at SPY, an S&P 500 ETF. And we're going to look and see how that has grown. I've done some other videos on SCHD, SOXX, and JEPQ. If you want to check out those, there's links below in the description. You can see those up here. I'll put the links real quick so you can click on those if you want to check out those. This is S&P 500, SPY. So we're going to go with the same scenario we've done in the other videos, where we look back to March of 2017, and we look at investing $50,000, a one-time lump sum investment, how that has grown since 2017. If you were to have put $50,000 in it, left it alone, and just let the dividends reinvest doing the drip, where would you be in 2024? Follow me and Simply Money as we look at things like this on a regular basis, and we provide other insights on how to budget, how to prepare for retirement, how to set up savings accounts, how to invest in HSAs, IRAs, how to maximize your 401k to prepare for retirement, how to get out of debt, how to build wealth, and how to live financially free. Those are just some of the topics we hit on in this channel, all things money on Simply Money. So today we're going to look at SPY, a $50,000 investment. As you can see here, the stock price when we first purchased it was $238.39. So we're able to buy 209.74 shares, and that is the $50,000. So the first month, the 17th, we were bought in time to get the dividend share, and we got $1.03 per share. And so the dividend payment was $216, allowing us to buy almost another whole share. Added that, our cumulative quantity here, you can see the price dropped down slightly, so our value is slightly below where we started. If things like that freak you out, you have no business in the stock market. You're going to have some dips and some high increases. It's going to ebb and flow. It is okay. You are investing long term. Remember that. Short term, month to month, even year to year should not impact your decision. You should be planning on long term. So let's skip down. We'll go up to the end of 2019. We'll see, if you kind of scan down here, you can see the stock price steadily increased, and it went up, and then right here we kind of peaked out at $321.59. Each dividend has been paid, $1.18, $1.44 up here, $1.57. It's slightly increasing each year. And then as you look over, you see we buy about a share each time we get a dividend. Not quite sometimes, a little bit more other times. And at the end of 2019, our share cumulative quantity is 222. We've gained 13 shares thus far on this scenario. You can see the total value has gone up here to $71,000. So you've had an increase in just under 3 years. You've had an increase of $21,000. That's a nice return on investment. It's the S&P 500. It's a good standard ETF to get involved in. But as with all the stocks, with everything, there's been ups and downs, and we all know what happened early on, first quarter 2020. COVID hit, stock market went bonkers, crashed big time, went down, people freaked out. It was a great time if you had money laying around to invest. But if nothing else, you held this stock, you rode the wave. Look at, by March 2020, the dividend was staying the same. Your dividend payment was $313. So you've gained almost $100 since your first dividend payment. Stock price, look at that, from just in December to there, it dropped almost $100, about a third of its price, 33% drop. You're able to buy 1.37 more shares with that dividend, brings your cumulative amount. Again, here's where people freak out. $71,000, 3 months later, you're down to $50,977. You're still up from where you invested. I know that seems like a scary thing. You see that big drop. That's part of investing. That's part of the slight risk you take, but long term, it rebounds. So let's look at this. We go down here. Let's just go to the end of 2020. So this was one of those stock market blips that hit hard fast and recovered quickly. Sometimes it recovers slower. Sometimes it can take a year, 2 years, even 3 years to recover. But again, if you're in this thing long term, you have time to ride that out. And if you're dollar cost averaging, buying each and every month or each quarter into your portfolio, these dips are actually an opportunity to increase your holdings. And then when the price comes back, gained even more return on your investment on those investments. But we're doing a one-time lump sum. You can see through 2020, the price bottomed out here at 228. Then it went to 307, 325, 364. So we're back a year later. We're back higher than we had been prior to the fall. So 364, you've again picked up another share each time you got the dividends. Dividends have stayed pretty consistent, maybe slightly increasing. You see that you've gained. Now you're up 17 shares here compared to where you started. But look, you've regained. You were at 71,000. You dropped to 50,000. Now look at you back up to 82,000. You're higher than you were prior to the dip. And that's okay. That's part of the ups and downs, long term. Let's keep looking at this. Let me scroll down a little bit. End of 2020, we're at 82,000. Let's go down here to right here, beginning of 2022. Again, another stock market run here going down, another stock market drop. People got scared, things panicked. Again, you didn't want to sell here when COVID hit. You didn't want to sell. This is when people panic. You're locking in that loss, that 71 to 50,000. You lock that in. If you had rode it out, you're back up. But again, right here, 2021 ended. Things were looking good. 2022 started ticking down a little bit. Second quarter started dropping. Big drop there. Look at that drop from $444 down to $371. But look, you're still up 35,000, almost 36,000 from where you began with your first investment. Yes, you dropped from your high of 104 down to 85, but you ride it out. You wait. You keep steady. You don't panic. And then what happens? We look down. We're going to just go down to the end here. March 2024. Look, your highest dividend here was $191. Got a $450 dividend payment. That's twice what you were getting when you first bought into this. Your dividend, your quarterly payments have doubled because you've increased the amount and quantity that you own. Great. Continuing to buy a new share every month. Again, sometimes a little bit higher, sometimes a little lower. But at the end of this, so 7-year stretch, you're up to $121,000. So if you had stuck out the lows, continued to just let it grow, continue to let it reinvest its dividends, you would have accumulated $9,000 in dividend payments. That's a little over $1,000 a year. I know that's not huge, but that's just money adding into this value increase. So you've had a share price growth increase of 114%. You've gained almost 28 shares. Your total shares that you own now is 237, and you've gained $71,000 in total value. This is where your value would have been at March of 2024. Again, this is why we look at these. I like these worksheets. It helps people see the highs and lows. It's so easy to get tunnel vision, so easy to be looking at the day-to-day, the month-to-month of your portfolio and panic. When you step back and get a bigger picture and see how it went and look at that and just watch it, you get to this ending and you get to see this is where I'll be. So imagine 7 years from now, if you just let this ride another 7 years, so in 2031, maybe you're going to be ready to retire by then. Maybe that's when you start looking at diversifying differently, a little bit more conservative. I don't know your place. I don't know your situation. Not giving investment advice. The advice I'm talking about here is financial advice, simply as investing for the long term, sticking to your plan, not panicking. What specifics you invest in is up to you. You and only you know what your financial situation is and where you need to be and what your tolerance of risk is. 7 years from now, imagine if you have this similar growth of 114%. In 7 years, this year will be about $260,000. Not bad. So in 14 years, you can go from 50,000 up to like 260,000, give or take. That's the S&P 500 SPY ETF. Back testing it since 2017, you can gain 114% return in those 7 years. I hope you enjoy these videos where we look at these Excel sheets and we break it down month by month, quarter by quarter, and you see how the dividend reinvestment works and how patience pays off. This is Simply Money. Check out our platform. Link is in the description below, where you can get all things financial in one place. It's like a shopping mall for all things financial. Do you need insurance? There's links for that. Do you need a home loan? There's links for that. Do you need to track your wealth? There's links for that. Everything on one page. It's like going to a shopping mall. Check out the link below. Just check it out. There's a free version. You can get on there and use it for free. You can get out of debt and set your budget. You can put cash accounts in there and set up payment savings for yourself to plan for a house, a car, vacation, set up these goals. It's a great opportunity to get control of your finances. This is Simply Money. Thanks for joining us. Leave us a comment below on what you think, and we will see you next time.